You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by our special guest today, Jon Kingham, who, if you've listened to the show before, you've probably heard of, is the author of The Defensive Value Investor, which is a book that we've certainly mentioned quite a few times on the show now. So, Jon, first of all, thank you very much for coming on the show. Could you just briefly talk about how you first became interested in investing and talk us through your investing career to date?
Yeah, sure. So, I started investing in somewhere in the mid-90s. I think it was about 95. And basically, I'd started work a few years before that, and I'd started to earn, reasonable amounts of money, had a bit of disposable income. And so I thought it would be a good idea to start saving up for my retirement. And I think somewhere along the way, I'd got the idea that equities was a good investment for the long term. So I ended up investing in a FTSE All-Share tracker. So that was it, really. So I started off in 95, started investing into a FTSE All-Share tracker, saved into that through until 2003. So basically, I rode the dot-com boom on the way up. And then there was the dot-com bust from 2000 to 2003. So the dot-com bust was not really a lot of fun. So from memory, it lost about, my portfolio lost about 50% of its value between 2000 and 2003. And at some point, as a novice investor, the pain exceeded my risk tolerance threshold. And I ended up selling everything in 2003, just because I didn't understand anything about investing. I didn't know just anything. I just didn't know how far the all share could go down, whether it would keep going down forever. It just was complete. I had no idea what I was doing. So I sold everything in 2003 and then decided that I should probably know a bit more about investing. So that's where it started to become kind of a hobby, kind of reading books about investing. But I was out of the market from about 2003 to about 2005. I think I put it all into premium bonds at the time. And then as I'd started to read different books, different trading strategies, turtle trading, all sorts of crazy stuff. And then eventually I read a book called The Intelligent Asset Allocator, which is a really good book that explains the efficient market viewpoint of investing. And so it's all about, it's a modern portfolio theory book. So it tells you to invest globally, to invest in stocks and bonds and commodities and spread your money all over the place. So that's what I started to do after about 2005. I started to invest in mostly through funds and index trackers. So I just built a globally diversified portfolio, which was actually very sensible. But somewhere along the way, I'd got really bitten by the bug of investing, and a kind of modern portfolio theory approach is very, very sensible, but it's also very, very boring because you don't actually have to do anything apart from a tiny amount of rebalancing. So through that period from about 2005 until the crash, another crash in 2009, through that period, I started to read about macroeconomics and I became a bit of a peak oiler. So I started to tilt my portfolio towards not oil stocks, but oil related funds, and possibly owning some sort of proxy for the oil price, the price of oil. And that turned out not to be a great idea either. But also I ended up reading The Intelligent Investor, which is the famous book by Ben Graham. Because it's mentioned in The Intelligent Asset Allocator, which obviously takes its name from The Intelligent Investor. So, and having read that book, where Ben Graham basically explains to you that when you're investing in equities, you're investing in businesses and that you own a business, and that if the price goes down, that's not necessarily a bad thing, in the same way that if the price of, the example Warren Buffett always uses is hamburgers. If the price of hamburgers goes down, that's good because you can buy more hamburgers. So in that pre kind of financial crisis period where I'd read The Intelligent Investor, I got bitten by the deep value bug. So I started to put, so I had some money, most of the money was in this modern portfolio theory approach. And then gradually more was going into the peak oil stuff. And then I also started to invest in deep value stocks. So basically deep value is you buy what are typically rubbish companies, but you can pick them up at extremely low valuations. So you can buy the whole company possibly for less than the amount of cash it's got in the bank. And because the valuation is so low, you're just waiting for sentiment to slightly improve, and then you could make a decent profit. Anyway, so then there was the 2009 crash. I ended up selling all of the oil stuff because that absolutely fell off a cliff, and I lost a ton of money in peak oil. So I realized that I'm not much of a macro economist, but the value stocks, the deep value stuff actually did okay through the crash because the price of these companies is already rock bottom. So when there's a crash, there's not really a lot of room for them to go down more anyway. So I ended up shifting more and more of my money into deep value stocks, and somewhere after around 2009, shortly after, I became basically fully invested in deep value stocks. So, and I did that for 2 or 3 years. I was then a pure deep value investor from about 2008-9 until about 2010-11. And gradually I realized that although deep value, it had worked reasonably well for me, it didn't really suit my personality. It's basically you're buying rubbish companies. All of the news that they put out, all of their annual results and statements and everything, they're all negative. Everything is basically going wrong. They're losing customers, they're making their staff redundant. It's not a happy place to be as a deep value investor. So I ended up reading the new Buffettology, which is obviously a book based on Warren Buffett's strategy, which is much more about buying very good businesses, high quality businesses, but trying to buy them at attractive valuations. So that sounded like it suited me more than the deep value stuff. And it also had a dividend focus, and I kind of liked the idea of dividends. And so in around 2010-11, I pivoted again to a kind of Buffettology-esque quality value or defensive value approach. And then since then, that's what I've been doing ever since. So for the last 10 years or so, I've been focused on higher quality companies, but still at attractive valuations.
So then what led to you writing your own book on defensive value investing and also the creation of the blog?
Yeah, so the blog started in about 2007 or 8, and it was just because I was reading articles from people like Richard Bedard or Phil Oakley and other people, and there were more blogs around back then, and investing was a hobby. So I just thought I liked the idea of writing a blog. First of all, it means that your analysis has to be more rigorous, because if you're going to do a write-up of a company and put it on the interwebs, then other people are going to read it and then they can critique it and tell you that it's rubbish and so on. So publishing your research makes you, should improve the quality of your research. But also it's a way to interact with people, because on blogs there's comment section at the bottom and people can comment. And over the years I've had lots of conversations with people through the blog. So that was how the blog started. And then the book just came off of that, where I think it was 2012, Harriman House, the publisher, got in contact with me to see if I wanted to write a book, because they'd seen the blog, and I'd also written some articles for other publications, other websites. I can't remember exactly who, and I'd done some kind of Q&As with different people. So they saw me, and then obviously they're a publisher, they want to publish books, so they just said, "Do you want to write a book?" And I said yes, and eventually it took about 3 years to get the thing done. But that was it, and the name, the defensive value investor, just came up in conversation with the guy from Harriman House, and then that label kind of stuck.
Well, we actually did review the book on the show, which I enjoyed. I think it took me like it was maybe like a day and a half to finish it. But it was gone pretty quick.
Right.
What I liked about it was very, very easy to digest. I like the way you'd actually like broken it down, and just the way you'd almost gone through like the balance sheet and income statement line by line.
Yeah, I mean that was kind of There's the process of writing a book is quite a long one, especially if you've got a professional publisher working with you, because they know much more about writing books and what people want to read than I do, and so they actually pushed quite a bit for me to put down the specific details. They were quite keen on that, because then it becomes more usable if people have got like the nitty gritty details of exactly how the different ratios are calculated and so on. So yeah, I was quite pleased with the book in the end. I've kind of, there's been a plan to write a second edition for a few years, but things have got in the way. But there will eventually be a second edition.
That was going to be one of my follow-on questions, actually. So is there anything that you think's anything fairly significant that's actually changed in your approach between writing the book and now then?
Yeah, I think yes. The most of the focus of the book is on quantitative factors, which basically the ratios that make up the stock screen that I use. So there's a metric to measure a company's long-term growth rate and its growth quality, which is a measure of how consistently the company's grown. And then there's profitability and debt ratios and capex ratios. So it's a lot of the kind of the numbers side of it. And there's a section in the book on there's a checklist that I use as well, which asks questions about the business model and so on. So more qualitative factors. And so the main difference really since the book was written is that the amount of time and effort that I put into the qualitative factors has grown fairly substantially. So the kind of the raw numbers, or the historical raw numbers anyway, it's the past growth rates and so on, they're still important as a way of finding companies in the first place, but then they're not as important in the final decision to buy a company or not as they used to be. They used to be kind of fairly important. If it ticked a bunch of quantitative boxes, then I might invest. Whereas now I use those quantitative factors to find companies, but then the analysis is much more focused on the qualitative side of things. And I guess also that the other main difference really is that I now build discounted dividend models for every company that I value, which is something I didn't do at all when I wrote the book. So that's obviously going to be a fairly major addition for the second edition.
Would you be able to just briefly talk about what exactly a discounted dividend model is then?
I will try, yeah. So basically the idea is that a company is only worth the cash that you can get out of it. So if you buy a company and it never, ever, ever returns any cash to shareholders ever, and then it goes bust and it is obviously valued at zero because it had no assets or whatever, or no assets that, the net of liabilities, then how was the company ever worth anything? How could a company be worth anything if you could never, ever get any cash out of it? And so you might say, well, I could sell the company I might sell its shares to someone else, for twice what I paid for them and make a profit. But then the question is, well, why would the next guy want to pay anything for a company that's never going to return any cash? So from a theoretical point of view, a company is only worth the cash that you can get out of it at some point. And so a dividend model, basically, you estimate out this future flow of cash. So basically the future dividends. And then the discounted part of the model is that it's just the idea that if I said to you, do you want £1 million today, or I'll give you £1 million 50 years from now, you're going to prefer the £1 million today, I would imagine. And so therefore £1 million 50 years from now is worth less than £1 million today. So the future is discounted. You literally discount the future. You reduce the value of cash flows in the distant future, because obviously you might be dead by then anyway. So or whatever. So basically the discounted part is that the further you go into the future, the smaller the the present value of those dividends becomes. And the model part is just that it's a quantitative model based on all kinds of assumptions that you have to, that basically that's the main part of analysing a company, is coming up with the assumptions that you can use to build the model. And then, then the last part is that the fair value of a company, or the present value of a company, however you want to phrase it, is then the sum of all of those future dividends ad infinitum, or at least until the company goes bust. So you model all the future dividends, you discount them at some discount rate that you can. Well, there are various ways to choose a discount rate, but whatever, there's a discount rate, and then you add all the dividends up, all of the discounted dividends up, and then that gives you your fair value estimate. And then the idea, of course, is to buy companies when they're trading at less than fair value.
Is that one of the, because you've got some free spreadsheets on your website, is that one of those? And if not, could you just talk about the spreadsheets that you've got on there that people might find useful?
Yeah, sure. So the spreadsheets that are on the website are the spreadsheets that I use on a daily basis to look at companies. And so there's basically a section at the top where you can dump in all of the 10 years of data for the company that you're looking at. So revenues, earnings, dividends, book value, cash used to buy back shares, just cash spent on acquisitions. There's all kind of important data points that you can put into the spreadsheet, and then obviously the spreadsheet will then calculate all of the main backward-looking ratios that I use. So growth rate, growth quality, profitability, debt levels, capex ratios, acquisition ratios, so level of acquisitions relative to earnings. So just a bunch of different metrics. And then there's another section where you can then build a discounted dividend model so that you can come up with an estimate of fair value. Yeah, and then there's a section where you can make notes and so on. But the main part of it is that it's a way to capture the financial history of a company, and then use that to project out your estimate of future dividends.
So as well, because you've got a fair bit going on, you've got the blog, you've got the book, you've also just launched a podcast. So could you just talk a bit about what that actually covers as well?
Yeah, so the podcast is new, so it's only on episode 3 at the minute, but the basic idea is it's going to be a podcast version of the blog posts. So or articles, on however you want to call them. So I've been writing a blog for about 14 years, which is a long time, and so basically my articles tend to be reasonably deep looks at individual companies, so companies that are suitable for a dividend growth portfolio, or that fit this kind of defensive value description, or it's fairly detailed articles about some aspects of investing in general, or the investment strategy side of things. So how you analyze companies, how you can value them, how you can look at maybe insurance companies, how you can do asset allocation or position sizing in a portfolio. And so then the podcast is just going to be, or is just a podcast version of that, because, more and more people now watch YouTube, or they listen to podcasts. Blogs are in slow decline, unfortunately. So, but I like blogging, I like writing, so I'm always going to do the blog. But this is just a way to kind of, reach more people.
So could you talk a bit about your investment appraisals process and what you do actually look for when you are looking at a new stock or a potential investment? And I know this is covered in some detail in the book for anyone that does want to learn further, if they do like your answer. Yeah,
so there are a lot of things really to look at. So what I would say the first thing is that I start off by dumping the company's 10-year track record, the 10-year financial data into the spreadsheet, so that I can just look at the numbers. And so the first thing that I want to see is a reasonably consistent track record of growth and a reasonably consistent track record of above average profitability. So growth is measured across, I want to see growth across revenues and earnings and dividends and capital employed. They're the main things that I'm looking for. And in terms of profitability, I want to see fairly consistently high return on capital employed. So that's kind of that's the initial, the numbers side of things. There are other things like debt. I have certain limits on how much debt I want a company to have. Ideally, and there are limits on how much capex. So I don't really want to invest in companies that are very capital intense. And acquisitions is another one. I don't like companies that have been built or grown primarily through acquisition, or at least in their recent history. I don't mind acquisitions that are 10 and 20 years ago, but if there's been a lot of fairly substantial acquisitions in the last decade, that's a problem, because it can cause all sorts of operational issues. So that's probably the backward looking things. And then looking forward, you want to see that the company, well, actually, okay, so I'll back up a bit. So in terms of the profitability, you can't magically produce higher returns on capital employed consistently unless you've got some sort of competitive advantage. And so when I'm looking at a company, I want to try to understand what its competitive advantages are, or if it even seems to have any. Because if I'm investing in a company, I want it to produce, progressive dividend growth for a long time. And that's not easy. That's difficult. Capitalism is very competitive. And so companies are only going to be able to produce consistent dividend growth for a long period of time if they've got some sort of durable competitive advantage. So a fair chunk of my time is spent trying to understand what it is that the company can do better than other companies, and how that's going to endure over time. And then beyond that, then I'll look at things like the market. How much potential disruption is there in the market from competitors or technology or regulation? How cyclical is the market? And then that affects how much debt I'm happy for the company to have. Obviously, the more cyclical the market, the less debt you want the company to have. And also just whether the overall market is expected to grow over time. Because, something like tobacco is in long-term decline, not necessarily to zero, but it's in long-term decline. So you want to see that the company has got other avenues that it can move into in order to offset that, or obviously, preferably, it's better to be in a company where the market's still growing at 5 or 10% a year. So I would say that's the main things. You're looking basically for a track record. You're looking for very successful companies that have already been successful for decades, and you want them to be in a strong position now, so they're not loaded up with debt or they haven't made any crazy big acquisitions. And then you're also looking for a relatively rosy future in terms of there being a lot of room to grow in the future.
So how do you then, once you've done that and you've found one of these companies, how would you then approach valuation? Because you've got, for a lot of those companies, you've got to pay up is the issue.
Yeah, exactly. So in terms of valuation, it's just about building out the dividend model. So the dividend model is mostly, well, initially, or actually, I'll say mostly, it's driven by the company's return on capital employed and its reinvestment rate, or its dividend payout ratio. So the foundation of a company is its capital employed. It's warehouses, factories, machinery, equipment, computers, whatever. And intellectual property in some cases. And so for most companies, if they want to double in size, they need to double the number of factories and warehouses and work in progress and stock and so on. And so you need to get money to pay for those things. And so obviously you can borrow money, or if you're talking about factories and warehouses, you can rent those, which is effectively borrowing them from the landlord. But my preferred route for companies is to not borrow money to fund growth, but it's to fund growth from retaining the cash, the earnings that they're generating from the existing business, which is where a nice healthy return on capital employed comes in. If a company's got a 5% return on capital employed, it's not going to be able to grow its capital base any faster than around 5% a year, unless it takes on, more debt. And so the basis of the model starts off with the company's capital employed, and then you look at what the return on that capital employed is, and then you look at how much of that return gets paid out as dividends and how much is reinvested. And that kind of gives you an initial picture of how fast a company can grow by retaining and reinvesting earnings. And then obviously on top of that, you've got to start to, that's just this kind of very simplistic quantitative model. And then you have to start factoring in all sorts of things like, what does the external environment look like? What's the company's market share? If it's a UK company, is it going to reach market saturation at some point? In which case you're going to have to look at how much room there is left in the market, and at which point is the growth rate going to kind of have to come down to inflation plus a small amount, or maybe it's got exposure to Asia, and you think it can continue kind of a double-digit growth rate for maybe a couple of decades before it starts to reach that saturation point. So from a valuation point of view, you build out the model. You put in as the most important assumptions that you can come up with, and then so a kind of essential idea of building a dividend model for me is that it should be realistic and conservative. They're the two ideas, or the two words that should describe the model. It should be conservative because you don't want to be over optimistic, because then you'll end up overpaying for companies. But you don't want to be so conservative that it's unrealistically conservative, because then your fair value will be so low that you'll never end up buying anything. So you try to build a realistic and conservative dividend model, and then the price is where it is. If a company's price is above fair value, then I'm not going to invest in it. I might put the company on a watch list and say, okay, well, this is what I think fair value is. Let's just wait and see what happens with the share price. If the share price, falls by 30-40% because the CEO does something stupid, or there's some scandal, or some kind of short-term non-material issue, which is, just gets investors excited in the short term, so the share price falls off a cliff, then the share price might be materially below fair value, and then I might invest. But basically, you build the model, and then the price is what it is. And you have to have discipline to say, I'm only going to invest if the price is X whatever percent below fair value, and if it isn't, then you don't invest.
Have you ever found yourself in a position where you've not really been able to find anything below fair value that you like, or have you always been able to find stuff? It's just a question of how hard you have to look.
Yeah, so the dividend models, I've only really got into building dividend models over the last year or so because of the pandemic. It was kind of, I did a kind of a root and branch reassessment of my investment strategy. Well, actually, it was before the pandemic, because I invested in some companies that kind of semi blew up. So there was clearly an issue with some parts of my analysis, and then we had the pandemic, and then I ended up buying too many companies. I went on a buying spree during the crash, and my portfolio ballooned up to 35 companies, and that was too many for me to manage. So there were these issues cropping up. So I went back to ground zero, and then kind of worked my way through my strategy, picking it apart and trying to improve it where I felt it needed it. And so one of the things that I ended up doing was these dividend models. So because I've only been doing them for a short period of time, and the UK market is no more than fair value and possibly attractively valued, there are plenty, or certainly enough, attractively valued high quality companies for me to invest in. Whereas prior to the financial crisis, my valuation method was much more based on my stock screen. If it ranked high on my stock screen, my assumption was that the valuation was okay, because my stock screen has a couple of valuation metrics, which is PE10 and PD10, which is price to 10-year average earnings and price to 10-year average dividends. And so there could never be a problem in valuation terms if you're picking companies at the top of a stock screen, because there are always going to be companies at the top of a stock screen, even in the US market now, which looks like it's in a bubble to me. If you're picking them purely off a stock screen, there's always going to be a number 1, 2, 3, 4, whatever on a stock screen. And so that actually was one of the issues that made me end up using dividend models instead, because it's more theoretically correct, and it's just more rigorous. But yes, in principle, yes, if the UK ended up in a massive, let's say the FTSE went to 20,000 in the next 5 years, it would probably be in a massive bubble. And at that point, it might be difficult to find enough attractively valued companies. And then I would have to deal with that problem at the time, either by concentrating on a smaller number of companies that were attractive, or just by holding more cash, or some combination of the two, I think.
So what are the best books you've read on the subject of investing? I know you touched on a couple of them earlier. And how much do you read in general?
So there are 3 books that really kind of shaped the direction of my investing. So the first one was The Intelligent Asset Allocator, which I think is probably, well, of the books I've read, it's the best general, quite detailed view of the efficient market view of investing, where the passive investing approach. So that gives you a very good grounding in how to think about allocations to stocks and bonds and commodities and private assets or whatever, different country allocations. And it goes into a lot of detail about why different allocations based on past, it talks a lot about the statistical mean return and the standard deviation of returns, so risk and return, and how that should affect different asset allocations. But really, that type of investing is unbelievably dull, because you don't actually have to do anything, which is fine for 99% of people. But if you want to be an active investor, but it's in terms of giving you a theoretical base, it's a very good place to start, I think. And then I read the Intelligent Investor, which is the book that really made me realize that when you're investing in equities, you are investing in businesses, and so you should view investing in the same way as if you were buying a hairdresser's down the road. It's a business, and you value businesses as if they're a business. And so you don't think too much about the ups and downs of the stock market. You think about how the business is doing, in its revenues and profits and so on. And then, as I've already mentioned, then I read The New Buffettology, which is just a very readable but good overview of the characteristics of high quality defensive. It's not really a dividend investing book, but a lot of it applies to dividend investing. So it's consistent defensive companies, mostly household names, and investing in them for the long term and buying them when they're at attractive valuations. So those are probably the main 3 investing books. There's a couple of business books. I really like the books by Jim Collins. So Good to Great, and there's another one, Great by Choice. And I've found that in Good to Great, there just seems to be, Good to Great really talks about how it's about building a good business from the inside, but it tells you a lot about the softer factors that you would maybe want to see in a business. So like people who are in the business for a long time. It's nice to see people like CEOs that have been in place for 10 or 20 years, or maybe started working in the business 30 or 40 years before, and companies that really focus on a core business where their goal is to be the best in the world at that particular niche. And then that they build some kind of, he calls it a flywheel, which is like a competitive advantage, basically, where you want some kind of flywheel where you work and become better at what you're doing, and the better you become, you can attract more customers, and then that builds your brand, and then you can build scale, and that gives you economies of scale and the ability to hire more talented people, and then you just reinvest those back into the business and become better and better and better at what you do. And hopefully the idea is that eventually you create a gap between you and the competition that is so wide that people don't even bother to try to compete against you because it's pointless. And so that's kind of the ideal situation. So anyway, so good to great is I think it's a very good way of looking at the softer, the non-quantitative factors in a business. And then there's one other book I wanted to mention, which was called Profit from the Core. I think that's what it's called, by a guy called Chris Zook, and he's written two or three books around this topic of focusing on when it makes sense to focus on the core business, and then how to expand an existing core business into new markets, and then when it makes sense to get rid of parts of the business that are not performing and to refocus on the core, and also to, even if there's a part of the business that isn't the core business but it has better economics than the core business. So for example, I wrote a blog post recently about a company called S3, which is a recruitment consultant, and part of their business was and so they operate in the STEM market, so science, technology, engineering and mathematics related jobs. And part of their business was something called the employed contractor model, which is where they find roles for freelancers in science, technology, engineering roles, but they employ the contractor directly, and then the contractor will work for S3, but they just go out and work for the end client, which would be maybe some company building a bridge, and then once the bridge is built, then they might go off and work on a nuclear power station or something. But that part of the business it just had better economics than S3's existing core businesses, which was non-employed contractors and permanent employees, or placing permanent employees. And so even though the employed contractor part of the business was small, they put a lot of effort into that part of the business and have very successfully scaled it up over the last decade. So the idea of profiting from the core is about looking within a business for the bits of the business that have the most potential, and then doubling down on those, rather than, there's kind of an idea of not worrying too much about the parts of the business that are problematic, because you can spend lots and lots of time and effort trying to fix a problematic part of the business that you would have been better off selling or closing down. So anyway, so good to great and Profit from the Core, I think from the operational business side of things, they're really interesting and useful books to read.
So you touched on this earlier, but what are your thoughts on the current valuations in the US?
Very high. I think the CAPE ratio, the Robert Shiller's cyclically adjusted PE ratio, which is just price to 10-year average inflation adjusted earnings. In the US, that's about 40, and the long run average is about 18 or something. So the US is currently about double its long run average valuation level. So obviously, if you're a US bull, there are a million reasons you can come up with to why the FANGs are going to take over the universe and Tesla, and that the valuations are justified and so on. But if you look back at a century of data, then the US market currently looks very expensive. There's no way of getting away from that. I think also the fact that nearly everyone is a US bull. You know, if you talk to anyone in investing, then they've typically got quite a high allocation to the US. They all want to invest in the US. They think the US has got the best companies in the world. It's the greatest place to invest. Let's put more money in the US. Everyone should have a high allocation to the US, blah, blah, blah. And, you know, if everyone thinks that a particular investment is fantastic, that and they're willing, and they kind of think, oh yeah, price doesn't matter. It's you know, it's all of the same things that was said in the dot-com boom, you know, that price to earnings didn't matter. What mattered was price to sales. And then if a company didn't have any sales, it was price to eyeballs or some other garbage. And so from my point, I mean, obviously I could be completely wrong, but from my point of view, I look at the US and I just think it looks like a very, very large bubble.
Do you think on average the businesses are a higher quality than they were in the tech bubble?
Yes. Okay. So yeah, the tech stocks, it's a different situation. Yeah. So in the dot-com bubble, I mean, I'm certainly no expert. When I was investing through the dot-com bubble, I didn't invest in any tech stocks. I worked for a tech company at the time, but I didn't invest in any tech stocks. But from what I do understand is that back then, obviously, it was there were a lot more smaller companies and more IPOs and that kind of thing. But then we've had a lot of that more recently as well. And so now it is different to an extent, because obviously you've got Amazon and Facebook and Netflix and Google and so on, and Apple. And so these are all very large established companies that actually make enormous amounts of profit. So that is different. And in terms of the valuations of those individual companies, I have no idea. I don't invest in the US, so I don't look at their valuations at all. But if you look at the valuation of the overall market, it's very, very high. And so it's hard to get away from, you know, just the fact that the valuation is very high, and that the CAPE and similar ratios have always played out in the past. That doesn't mean that they're right this time around, but if you look in well over a century of data, and across decades and decades of data across all over the world in different countries, trees don't grow to the sky, and at some point. But the thing is, in terms of the sentiment as well, is to me that's the thing. It's just that everybody thinks the US is fantastic, and so as a contrarian, that just rings a lot of alarm bells.
So what do you think of valuations in the UK?
So the UK is completely different. It's the CAPE ratio is about 16, which is the long run average. So on that basis, the UK looks like it's about fair value. But just, you know, anecdotally, it's just nobody in the UK is really interested in the stock market. In the UK, it's all about the housing market, which is in its own bubble. And even internationally, you know, since Brexit, lots of institutional investors reduced their allocation to the UK. And if you look at things like dividend yield, which I think it's around 3% or something, I think, on the FTSE 100. But that's on a reduced dividend because of the pandemic. So there's, you know, on no reasonable metric is the UK expensive. The main difference, I would say, without being an expert on the US market, is the tech stocks and the ability of the US to scale up companies from scratch into these massive dominating world leaders. And there doesn't seem to be anything like that kind of capability in this country. So yeah, I would say on average, I don't know about quality. Quality is a tricky word, but I think in terms of long-term growth rate, yes, you would expect the US market to probably have the underlying companies to have better long-term growth prospects than those that are listed in the UK on average. But that doesn't mean that the US market is going to outperform the UK market, because the US market is currently running at about twice its long run average valuation level, its CAPE ratio. So the US market could quite easily be flat for a decade, and in valuation terms, it still probably wouldn't be back to fair value.
Yeah, I'd be inclined to agree. I think in the UK, I mean, me and John talk about it fairly regularly. I think what we lack in the UK is like you said, it's a tech sector. And I think that's shown by like the media trying to portray like businesses like Ocado as a tech company. And I think in the US, because my own portfolio is split about 50% US, 50% UK. And I think in the US, it's probably easier to find high quality businesses. The problem is the valuation, because some of them are eye-wateringly expensive. But I think in the UK, when you do find
Tesla's the obvious example.
Well, yeah, Tesla's just ridiculous. I mean, that's about 20 times sales, which for a car company is absolutely insane. I mean, I recorded an episode the other week, but Tesla's worth 17 Fords or something like that. It's absolutely insane.
Yeah, and so I saw a graphic the other day, and it was a pie chart, and it showed that Tesla its market cap was more than every other listed car manufacturer on the planet. I think that's what it showed from memory. I think it was that. I don't think it was like versus the top 10. I think it was like everyone.
The second biggest is Toyota, and they're about 200 billion market cap. So if that's the second biggest, then
but that's market cap. If you then look at a chart that says how many cars do they make? I know obviously the argument with Tesla is that it's not a car manufacturer; it's some kind of magical thing that can dominate every industry it wants. Including that, like they're going to have a Tesla phone or whatever. But if you look at it just in terms of the business at the moment and how much cars it makes or how much revenue it makes, and it's not even on the list really. It's not even in the top 10, I don't think.
Well, if you compare it to the other $1 trillion companies, I mean, Google, for example, that's at a PE of like, I think it's maybe like 26, 28. Facebook's about 28, 30.
And they make stupendous amounts of
exactly. It is very much the odd one out when you actually look at those businesses.
And then also, so from a social point of view, if you look at sentiment, if you go on YouTube and type in Tesla stock and look at the videos that you'll see, it's just every single video says Tesla will, and everything. It's all the titles in all caps. Tesla will destroy Apple or something. It's game over for everyone else, and that's it. And so there's just this kind of tsunami of young people many of whom I assume don't know anything about the Tesla business at all, other than that they can buy fractional shares of Tesla on the Robinhood app with no fees. So I mean, maybe they're all right. I'm wrong, and I'm just going to have to. What is it they say? It's have fun being poor.
Have fun staying poor. That's it.
Yeah, that's it. So maybe I'm just going to be poor, but I look at it and I just think, okay, that a Tesla has to perform so mind-bendingly well over the next 50 years to justify the current valuation.
Well, yeah, that's it. And they could be right about Tesla, the business, and then. But from a stock perspective, how many of those
returns
have been pulled forward? Because I mean, if in 10 years' time, Tesla's got the same market cap and it's got $50 billion of earnings a year, which is an insane number compared to what they're earning now. I mean, that's a PE of 20, which is still quite pricey. But I think in the UK, I think when you do find those businesses that are high quality and growing. So an example is a business we'll talk about later, but Hargreaves Lansdown, for example. I mean, the last 5 years, they've basically doubled the number of customers and the business just hasn't moved. It's a PE in the low 20s. And I don't know what that business would be worth in the US, but I think it wouldn't be at a PE in the 20s for the kind of figures it's been putting up over the last 5 years.
I think the one that springs to mind for me is Legal & General, which is something I own, where you start to feel in some of the presentations recently that the CEO is beginning to be annoyed by the fact that Legal & General has got a dividend yield of about 7%, even though they've grown at a double-digit compound rate over the last decade, and so thereabouts. And so they've started to compare themselves explicitly in some of their shareholder the events that they do to companies like BlackRock or to US companies, and they're just saying, well, look, we are basically the same as some of these other companies, and look at the valuation difference. You know, they're trading on like half or less of the multiples of some of the US companies that don't have any better competitive advantages than them. So I think, I think to an extent, the UK companies, there's just a lack of capital coming into this country because of, you know, it's not the US, because all the more money that floods into the US, the less there is for the rest of the world. But also Brexit and other bits and pieces, but that's fine. As an investor, I'm quite happy with that, because it means I'll get a better dividend yield out of a high quality company. So I don't mind. In fact, I wish more people would invest all of their money in the US, because then the UK companies would be even cheaper.
Yeah, that's it. And the thing is, you don't actually need a multiple revaluation, because if the business could stay at the same PE, and if the earnings grow, you can do very, very well.
And if my dividend models are right, then my return will come from the dividends anyway. You know, the fair value is based on the dividend. So I don't. It's like if you bought the company outright. If you buy a company outright, you're not interested in whether you're going to sell it to someone else or not. Your return comes from the business. It comes from the cash that comes out of the business.
Yeah. So what are the best resources that you use for investing? And these can be free or paid.
So the main one that I use is SharePad and ShareScope. I've used those for I think at least a decade. They're paid services, but if you want what I want is lots of data. So I want at least 10 years of data on every company I look at, and I want lots of different data points. You know, all of the main financial things off of the income statement and the balance sheet. And it's just very easy to get them out of either SharePad or ShareScope. So that's something. And also you can set up portfolios in SharePad and then look at all the news that comes in for a portfolio. So I have my portfolio in SharePad, and then there's a tab where you can then look at all the RNS announcements that come in. And that just makes it very easy to go, you know, to know when annual results have come out, or interims or whatever. So that's the main ones that I use in terms of getting the numbers. And then obviously it's beyond that. It's just the company's own websites, looking at the annual reports. I like to watch the webinars that they do for quarterlies or interim and annual results, or when they do like an investor day or something. And then also, and then just like the internet in general, you know, whether that's trade magazines for, I don't know, insurance or recruitment or something. I like to try and find interviews with the CEO, because then you can get a more kind of nuanced view of a company if you can read interviews with the CEO or other, you know, high up management types, I guess, because they'll say things in interviews with industry magazines that they might not say in investor presentations. And then obviously you've got YouTube, where more and more stuff is on YouTube, so it's quite a good place to go and dig around, and you can find, you know, sometimes CEOs will go to industry conferences, and they'll do a talk about this or that, and then, you know, they might do stand up and talk for an hour. That's one of the companies I own is ITV, and so ITV it's a TV business, so the CEO tends to be high profile within the industry. So there's quite a few interviews and whatever with the current CEO and the previous CEO, and it's just you can get it helps you flesh out your view of a company if you can find and watch those kind of interviews, and you know, it just gives you a more rounded view than just reading the annual reports. So yeah, I would say that's probably SharePad and ShareScope are the main ones, and then just scouring the internet for other information.
Do you use Twitter as a resource at all? And are there any Twitter accounts that you'd recommend following?
Not really. I'm not a massive user of Twitter. I do go on Twitter, and it is a useful way to find other resources. I think I probably found your podcast through Twitter, I think. But I certainly don't use it as a source of investment ideas and that kind of thing. I have my own stock screen. I very much just follow my own approach and come up with my own ideas. But I guess, I mean, the people that I follow on Twitter, obviously apart from your good selves, it is just the people that I've followed for a million years, back before Twitter existed, which is people like Richard Bedard, Phil Oakley. I was going to say Maynard Patton, but I'm not sure if he's got a Twitter account. He may have one. I'm not entirely sure. But yeah, so Twitter's not. It doesn't make up a big part of my my research process.
What do you know now that you wish you'd known when you started investing, and what advice would you give to yourself when you were just starting out, if you could? Probably
the biggest thing, because I sold out in 2003 after the crash. So probably the biggest thing would be to say that price and value are not the same thing, and that when you're investing in equities, you're investing in companies, and just because the price goes down by 50%, that doesn't mean the value of your investments has gone down by 50%. That just means that someone else's opinion of their value, or it's not even that. It's you don't. The market can go down because other people have got liquidity issues, like they're getting a divorce and they need to pay for that or something. So you never know why other people are selling at the price that they're selling, or buying at the price that they're buying at. And so if I'd have understood that price and value are not the same thing, and that instead of looking at the price going down by 50% and that being very scary, I should have looked at maybe the FTSE All Shares dividends would have been, I think, a good starting point. And then I could have looked at the dividend, and I don't think the dividend particularly went down much in the dot-com crash. It might have gone down a little bit, but probably only 5 or 10% at most. And then I could have looked and said, oh, well, look, in 2003, the yield on the all share is, I don't know what it was, but let's say 5%. Whereas in 2000, at the peak, the yield would have been maybe 2%. So that, in fact, in 2003, instead of selling out because it had gone down, if anything, what I should have done was I should have saved even harder and put even more money into the market, because my money going into the market in 2003 would have been buying me the all share with a 5% yield instead of when I was investing in 2000 with a 2% yield. So I think that would have been the single biggest lesson, is that don't look at the price. Don't look at the price as if it's for information about your investments. If it goes up, if the price doubles, that doesn't necessarily mean that you could just be completely lucky. And if the price halves, that's not necessarily a bad thing. It could be a good thing. One last thing I was going to say was also probably have a slightly better idea of what you're doing before you start to invest. That would generally be a good idea.
So how do you think about allocation and position sizing in your own portfolio?
So for probably the first, and until recently, I didn't really think about it. If I had 30 companies in my portfolio, which is what I used to typically have, then I would start each position off with just approximately 1/30th of the portfolio. So all of the positions, at least the opening size, would be 3 or 4%. So about 1/30th. So just the average. And then as companies do well or badly and their stocks go up or down, then I wouldn't really do any position sizing. I would just leave them all in the portfolio just to kind of get on with it. And the only thing I would do is cut a position back if it exceeded 6%, because that was kind of my upper limit on position size. But now that's completely changed now. So one of the things that I came up with when I did the kind of root and branch assessment of my approach after the 2020 crash was that I read a book. Actually, I read a book called Warren Buffett's Ground Rules: Words of Wisdom from the Partnership Letters of the World's Greatest Investor. So it basically goes through Buffett's letters that he wrote when he ran a partnership before Berkshire Hathaway in the 1950s and 60s. And it's a good book. It's kind of very you get to see the kind of the semi-mechanical approach that Buffett used to use back then, which was based on a discounted cash flow analysis. But one of the things that he spoke about in the book or in his letters was about position sizing and about how the size of a position should depend on the risk and return profile of an investment. So the higher the expected return, the larger your position size should be. And the higher the expected risk or the variance of possible returns. So, you think maybe it's going to produce 10% a year, but it might, there's some chance it could go to zero, for example. Then of the higher the expected risk, then the smaller the position size. And so now what I try to do is to take both of risk and return and use those to calculate a target position size for each holding, which is based on the risk side of things. I just categorize companies as either quality cyclicals or quality defensives. And I'm happier to have a larger position size for the more defensive stocks, obviously. And then on the valuation side, I calculate something called a margin of safety, which is basically the gap between the current share price and fair value. And the bigger the gap, the bigger the position size will be. And so what that means is that whereas before my portfolio's position sizes were effectively random, there was no kind of, there was no design to it at all, other than that there was a maximum position size of 6%. Now, when I look at my portfolio, all of the largest positions, so I've got some positions at 6 and 7%, the largest positions are in the companies that I think are the most defensive and with the best expected return. So, which means they typically tend to have the highest dividend yields as well. And then the small positions, like 2% or something, that will be typically more cyclical companies where I think the price is getting close to fair value. So that's been quite a big shift over the last year.
How much time do you spend a month on investing in your portfolio?
It's hard to say because it's all kind of, investing is my job as well as a hobby. So I think if I wasn't running my website and newsletter and the other bits and pieces, and I was just doing it purely for myself and purely running the portfolio, I think it would be probably between 5 and 10 hours a week. I think that kind of ballpark, like an hour a day, and maybe an hour or two at the weekend. And obviously it varies depending on whether it's results season or not. Obviously in results season, there's a lot of work to do analyzing all the results and updating all the dividend models. But most of the time, I would say, yeah, probably a few hours a week, maybe 5 to 10 hours a week.
What are your thoughts on Bitcoin as an investment?
Okay, well, so technically, my definition of an investment is one that generates cash flows. So from that point of view, Bitcoin isn't an investment. It's pure speculation, which is not. That's not necessarily a bad thing. It's just that, So for example, if you could buy and sell antique teapots. A teapot doesn't generate any cash flows, not that I'm aware of. So you can only generate a profit by selling it to someone else. And then they can only generate a profit by selling it to someone else. Or obviously in the case of a teapot, it's utilitarian to some extent. But if we're talking about something that's got no art or something, it's pure speculation. So you're basing your decision to put money into it purely on the idea that you can then sell it to someone else at a profit at some point. And so, but which is fine, if you can do speculation, then great. But to me, it's not investing. To me, investing is you put money into something that generates a cash flow, and then you can value that thing based on the future cash flows, and then you can make a rational decision about whether you want to invest in that thing or not. So I certainly don't own any. Unfortunately, I don't own any Bitcoin.
So would you ever consider gold and commodities as an investment then?
I think they can make sense as part of a modern portfolio theory type portfolio, and the reason is that part of the modern portfolio theory is that you can the free lunch is the rebalancing. There's this the idea that there's no free lunch in I can't remember what the context is, but anyway. There's a saying that the only free lunch in investing is diversification, and really what that means is the rebalancing. So if you have uncorrelated assets, so you've got equities and bonds, and uncorrelated just means that they go up and down at different times, and then the rebalancing is if stocks go up a lot and you were supposed to be 50-50 between stocks and bonds. If stocks go up a lot, then you'll have a heavier weighting towards stocks, and you might be 60-40 or 70-30 or something. And then you can sell some of the stocks to rebalance back into the bonds. And in doing this rebalancing, you end up generating additional returns and in fact reducing risk at the same time. So having gold and commodities and things that don't generate cash flow means that they're still not technically an investment, but if you have a policy of rebalancing, then they can make sense because you can generate a return because they're uncorrelated. Their volatility is uncorrelated with stocks. So they're an investment from that sense, but in a kind of pure technical sense, they're not, because they don't generate cash flows. But if I ever went back, if I decided at some point that I didn't want to invest actively, then I think, to be honest, I'd end up in a Vanguard life strategy fund or something. But I might end up building a modern portfolio theory style portfolio, and gold could might be 10% of that or something.
So we've gotten to the end of the questions about, I guess, you're more of your towards your investing philosophy. So now the rest of the questions are going to be about, well, your actual portfolio and specific stocks. So you've got a model portfolio on your blog, which your own portfolio mirrors, and that started at 50k in 2011 with the objective of growing it just over 10% a year to $1 million by 2041. Could you just talk about this and how it's going? And also, you're behind your target, but you're ahead of your benchmark with a 10-year return of 129.3%. So could you also just talk about your thoughts on that as well?
So basically, so I started the model portfolio in 2011, which is when I started writing an investment newsletter at the same time. And it's basically like a virtualized version of my real world portfolio. And the target, the current target is 10% annualized, and the current return, I think, I haven't got the numbers in front of me, it's like at high 8s or something. So as you say, it's ahead of the all share, which is around 7.5% annualized over since 2011. So I would say I'd say it's the performance so far is in the okay zone. It's not good because it's not exceeding my 10% target, but it's not bad because it's still outperformed the all share. And also importantly, it's had a higher dividend yield than the all share through its entire history. So that's an important part of what I'm after. How's it going? I think basically I look back at the first 10 years as kind of an apprenticeship of this kind of Buffettology-esque high quality dividend growth investing. And so I think looking forwards, I'm fairly, I don't know about optimistic. I would be surprised if the performance of the next 10 years wasn't better than the performance of the last 10 years, because I know now, that I just know a lot more about investing in companies than I knew 10 years ago. And the process of stock picking and portfolio management is significantly more mature and robust than it was 10 years ago. So my hope is that over the next 10 years, the portfolio can inch its way up and exceed its 10% target by the end of this decade.
You typically, I mean, this might be slightly different from when I wrote the question, because obviously, like you say, you changed your technique during the pandemic, but you typically sell companies once you feel they're less attractive in your defensive value metrics. For example, if the valuation runs up significantly. Are there any companies you hold or that you've held despite you think them being slightly higher value than you would have liked, just because you like the business that much?
No. So I still have the same approach of I either trim positions as the valuation becomes less attractive, or I'll sell stocks if the price gets too close to fair value, or especially if it goes above fair value. But would I hold on to a company that was trading above fair value just because I really like the company? No, because I would be owning the company on a sentimental basis, which doesn't make any sense to me. So I think if from a rational point of view of getting a return out of the investment, or above average return or market beating return, then no. If the valuation is close to or above fair value, then I wouldn't want it in the portfolio. I'd be quite happy to buy it again, and I would probably move the company onto a watch list and then keep an eye on its valuation. But no, there's nothing. I don't want to hold companies just on a sentimental basis.
So you only hold UK listed companies, but you aim for 50% of your revenues to be generated internationally. So could you just talk about why you think this is important?
Yeah, so it's just diversification, basically. So you can diversify by owning lots of different companies, or a sufficient number, which is, whatever. I used to hold 30. I'm in the process of kind of reducing that down to about 20 at the minute. And then obviously you can spread across different industries, because you don't want to own nothing but life insurers when the government decides that people they don't have to buy annuities anymore, as they did a few years ago. So you diversify by industry because they have different cycles, and it reduces regulatory risk and so on. And it's the same with countries. I wouldn't want to have all of my companies heavily focused on the UK, because who knows what's going to happen to the UK in the future. I live in the UK, I work in the UK, and if all of my investments were in the UK, if there was who knows, very, very unpleasant things happen to the UK at some point, why would I want my portfolio to be damaged along with other aspects of my life? I think it makes more sense to have a material amount of the cash, the dividends that come from the portfolio are basically generated from all over the world. So it's just diversification. It's just insurance against or a hedge against bad things happening in the UK.
You allocate yourself buy months and sell months, where on a set day of the month you'll alternate between buying a new stock and selling an old one. How did this idea come about, and why do you think it's beneficial?
Yeah, it's not quite on a specific day, but yes. So once a month, typically once a month, or at least it has been every month since 2011, I will either buy or sell one stock. And so the idea is that you're going to have to, there's going to be some level of turnover in a portfolio anyway, because otherwise you're just buying a hold, and then that means that you're not going to sell things where the valuation isn't attractive, or buy anything else where the valuation does become attractive. So there's going to be some level of turnover. And I think during 2020, there was a period in 2020 where there was nothing to do in my portfolio for about 6 or 7 months. And I found that, well, apart from it was boring, that I started to look at other ways of investing, and I could kind of see that I was going to maybe drift off from what I actually wanted to do onto something else, just to give me something to do. So I thought about it for a bit. And so I thought, well, if I have a structured mechanism, like a monotone, like a kind of a drum beat going on in the background all the time, and there's this kind of monthly rhythm of once a month, I can look at the portfolio. So I know I've always got something to do each month. I've got some decision to make, and I can look at the portfolio and say, okay, well, is there anything that I really want to get rid of because the valuation's not attractive? And then I can spend some time reanalyzing the company, just make sure the dividend model makes sense. Is it too optimistic, pessimistic, whatever? And then I can sell something, or I can look at the stock screen. Well, obviously, I typically do both. I look at the portfolio. I used to alternate back and forth, buy, sell each month, which I don't do that anymore. Now I try to do what I think is best for the portfolio. So I look at the portfolio. Is there anything I want to sell? If yes, okay, then I'll get rid of it. Oh, but also look at the stock screen and then analyze some companies that I don't own to say, well, is there anything outside the portfolio that I think should be in the portfolio? And just having it as on a monthly basis just means I've always got something to do. I've always got something to work towards. And I think that is over the last 10 years, it's proven to be a reasonable pace at which to turn the portfolio over. But I mean, possibly there could be a time when there's nothing to sell and nothing to buy, in which case I would probably maybe just rebalance some existing holdings. I might trim something back that was less attractive and top up something that was more attractive. But I think it's probably useful for me anyway to always have something to do each month.
Can you talk about why you like moneysupermarket.com in spite of its current challenges? Well, for disclosure, this is a stock that I actually own as well.
Yeah, so by current challenges, I'm assuming you mean the energy crisis that we've just been through. And also there is also some regulatory issues with in the insurance industry. So okay, so why do I like it in the first place? Because it ticks the boxes that I like to see. So it's got a consistent track record of growth. It's got very high returns on capital employed, above 25%. Doesn't have a lot of debt. It's not a capital intensive business. It's got scale. There are elements of network effects in the business. So in other words, it's an advertising platform. So basically, it brings together eyeballs and ads, to use that phrase. So the more people that go to Money Supermarket, the more attractive that is to British Gas or whoever. And so they want to come on the platform. And then the more providers that come on the platform, then it's more attractive to people looking for bargains. So there's an element of network effects in the business. And that's obviously like an extremely powerful competitive advantage. Although having said that, it's not like Rightmove, because in the comparison website market, there's more of a balance between, Money Supermarket and Compare the Market and go compare, although that's a bit smaller, and you've got U-Switch, and so it's a bit there is more balance. It's not kind of a completely one-sided thing, but certainly if you were setting up a new comparison website today, you would have to throw unbelievably huge amounts of cash at the advertising to pull people away from the incumbents. Anyway, so there's that. It's got the good track record, competitive advantages, lots of high profitability. I think comparison websites, it's still a growth business. The expectation is it will continue growing as all of the baby boomers move on to the next phase of their existence and are replaced by Gen Z and Gen Y, millennials, who are obviously much more online as they come through, and they start to be the people who own houses, rent houses, pay gas bills, have car insurance, and so on. They're not going to look at the yellow pages. It's all going to be done online. So the expectation is that price comparison is still a growth market. And then the last thing is that I like Money Supermarket because it's probably the most diversified of the comparison websites, because it's split fairly evenly between utilities, gas and electricity, and all the car insurance stuff, and credit cards, and mobile phones, and broadband. And so it's got quite a diverse business. So in terms of the current problems, it's the diversity really is the main thing, I think. So the energy crisis is a problem, and it's the revenues from energy switching went down by 50%. But energy only makes up 25% of the overall company's revenues. So it's a problem, obviously, but it's not a life-threatening problem. And it's not a permanent problem either, because the energy price cap will go up a lot over the next it goes up every 6 months, I think. So over the next 2 or 3 times that it gets bumped up, it will get bumped up a lot. And eventually, not every deal in the market will just equal the price cap. There'll start to be, variance amongst the different offers, and then switching will come back. And even if a lot of energy companies the smaller companies go bust, as long as you've got kind of double-digit numbers of suppliers, then you can have a healthy switching market. So I don't think the energy switching market is permanently damaged, and this is likely to be a reasonably short term, like a year or ish, an issue. I mean, it may they may even like cut the dividend in the short term to be on the safe side, but I don't think it really materially changes the longer term picture. And then the insurance one, the regulation to stop price walking and offering new customers better deals than existing customers. With that, it's a case of just, I don't know, no, we don't know. But partly, again, it's diversification, where insurance, I don't know the exact percentage offhand, but it's not a humongous part of their business. And so it's an unknown, it's an uncertainty. It's very likely to be a headwind of some sort, but I don't think it changes the picture that people are still going to want to look around for insurance deals, and that more and more people drive cars, number of people driving cars will stay fairly flat. But as more Gen Zs and younger people come through, they'll look for car insurance on comparison websites even more than the older generations. So I think it's again, the switching thing will be a short-term headwind, and I'm sure lots of clever people work in Money Supermarket, and they're not just going to sit there and do nothing. I'm assuming that they will think of various ways around it, and that it will be it's a bump in the road. But then the whole point of looking for high quality businesses that don't have a lot of debt is that they can absorb bumps in the road without, careering off into a hedge or something. So for me, it doesn't materially change the long run picture.
So we're going to now talk about another stock that I own, which is Hargreaves Lansdown. So could you talk about why you like that business?
Yeah, so it's the same kind of thing, really. So Hargreaves Lansdown's got, very good track record of growth, like insanely consistent. It's in my note, I've got a couple of notes here, and it says crushing dominance, which I think kind of describes Hargreaves Lansdown. It's got more than a 40% market share. So you would really, really not want to compete against Hargreaves Lansdown. You've kind of got to be slightly crazy if you want to try and compete against this company. But it's got return on capital employed is above 50%. It's just an absolute monster, and it operates and it doesn't have any debt. I mean, Peter Hargreaves has always been kind of anti-debt. He hates the idea of borrowing any money, and so it has no debt, never has had any debt. It operates in growing markets because asset values go up over time. So if you're an asset manager, you've just naturally got a tailwind of the growth of overall stock markets and so on. Yeah, so I mean, there's a lot of reasons to like it. I think the reason to not like Hargreaves Lansdown is its market share is so massive that there's just no where is it going to grow in its core market. It's just so dominant, and somehow it still keeps managing to push its market share up. But obviously there's a hard upper limit at 100%, and it's never going to get to 100% anyway. So at some point, and so what they've been looking at more recently is things like moving into the cash market. So they don't do any, they've only just started to do cash ISAs and become a broker for cash savings accounts. So they've got a thing called, actually I can't remember what it's called, Active Save or whatever. There's some saving product that they set up where through your Hargreaves Lansdown account, you can then go and look at a bunch of savings accounts with different banks, and so Hargreaves Lansdown effectively acts as a broker. So there's this whole cash market to go after, and the UK is quite a cash centric savings market. We're not like Australia, I think, and the US, where a lot more people put money into the stock market. I'm not sure if I know anyone in my normal non-investing life who invests at all. My parents, I think, had just, their money was in, well, apart from their pension stuff, but they was just saved in cash. And so the cash ISA market in the UK is huge. And if I was an existing stockbroker or bank or whatever, and if I had a significant cash ISA business, I would be terrified of Hargreaves Lansdown coming into this market, because it's gonna try and hoover up huge volumes of cash ISA money and then market to those people that, hey, maybe you should have more of your money in equities, and it will try to pull them onto its equity platform, because obviously that's high margin. So I mean, from that point of view, it all looks pretty good. Although I should mention one other thing I've not noted down, which is Robinhood. There's kind of this idea that, and it could be true, that Robinhood is a threat to Hargreaves Lansdown. The whole fractional share ownership and no fees kind of thing. I mean, first of all, we've got to see if that even lasts long, if that doesn't get squashed by regulators at some point. But really, that's aimed and attracts people at who are much earlier in their investment lifetimes. So typically younger people with much smaller amounts to invest, because they're the ones who want to save the £10 on a trading fee. Whereas Hargreaves Lansdown, its customer base is getting slightly younger. They are picking up more younger people. But mostly it's people who are, much later on into their investment lifetimes, and they have very significant amounts of savings, maybe, 6 figures plus. And if you've got £200,000 that you want to stick into an ISA or something, you're probably not going to put it in Robinhood, I would say. Most people, maybe you will, but most people would look to the existing, that you would want. Safety is the main thing. And so if you go on that basis, there's only a handful of companies really in the UK that you're going to look at, and Hargreaves Lansdown is the main one. And also, there's so many people on Hargreaves Lansdown. If you work in a company and you talk to people about investing, probably half the people that you talk to who do any sort of investing will have their money with Hargreaves Lansdown already, and so it's kind of becomes the default choice anyway. So as yet, I don't see something like Robinhood as being a material threat.
Yeah, I don't as well. Like, one thing I think with Hargreaves Lansdown is, I think because if you look at what's happening with like businesses like Hargreaves Lansdown in the US, the fees have been pushed down to basically zero over the last few years. But I just think, last time I looked, I think their assets under management was something like 130 billion, and I just think there's always going to be ways to monetize that. So if there's not an initial fee, there's other stuff they can do. So as long as that assets under management keeps going up, they're going to be able to monetize it. And then as well, if you look at Robinhood, there's no visible fee, but they're then selling the order book, so they're still getting the money out of you.
Yeah, of course. And there's no fundamental reason why Hargreaves Lansdown couldn't do whatever it is Robinhood do anyway. So I mean, I don't think that they will. I don't see that's the route that it will go down. But you just think, okay, well, if they can do it, then Hargreaves Lansdown can do it. And then how much scale in this country has Hargreaves Lansdown already got, in addition to all of the trust and the brand, and it's been around for 40 years and all the rest of it. So, exactly. Even if fees are zero, then okay, Hargreaves Lansdown sticks its fees to zero. But money still has to be made somewhere. And if you've got more scale and brand equity than anyone else, you're still going to make more money than anyone else.
I just think as well, like if I think about the people that I know, it's certainly like older people that have a good amount to invest. They just want the best platform, and Hargreaves Lansdown is a platform that everyone else is on and that they trust.
Hargreaves Lansdown has always just there's something that they just have this magical ability to look trustworthy. I think that's what it boils down to. I think Peter Hargreaves was a direct marketing genius. He was just a genius at writing letters that they would send out to people, and their newsletter that they used to send out, and the adverts and whatever. And if you look at their website, and they just exude kind of professional competence, and that is exactly what people want when you've got £100,000+ that you're going to put somewhere. It's why they used to build banks, and they used to put marble all on the front and whatever, because it makes it look sturdy, So it's the same kind of thing. It's Hargreaves Lansdown are just really, really good at looking like it's somewhere that you could trust to put your money. Obviously, the other big players are trustworthy as well, but I just don't think to the same extent they're able to. The marketing machine of Hargreaves Lansdown is just terrifying if you're a competitor.
I think as well, I've not looked at it since the full year results, whenever the last set of results came out, but I think from memory, I think they're about 1.6 million customers now, because I think it doubled from that 800,000 5 years ago.
That sort of ballpark. Yeah,
I think the next biggest is Interactive Investor. I think they're at about 400,000 or something. It's just the gulf is massive. They are absolutely dominant. I mean, we've looked at AJ Bell a couple of times on the show, and AJ Bell,
because that's the two obvious ones, isn't it? It's the Interactive Investor and AJ Bell.
Yeah, and AJ Bell, because they're listed as well, and it's a good business, but they're at like $250,000 or something like that. And every time we've looked at AJ Bell, my comment's always been, I don't know why you would want to own this instead of Hargreaves Lansdown, especially when AJ Bell's at a PE of like. I appreciate they've probably got more room to grow because they are that smaller number, but AJ Bell's PE is like 40 or 50, and Hargreaves is the low 20s. And to me, Hargreaves just looks like the better business.
Yeah, and it's got better margins and much higher returns on capital, and and for AJ Bell to grow, it's got to take customers away from Hargreaves Lansdown.
Yeah.
Whereas Hargreaves Lansdown is obsessed with getting people on the platform and then getting them to transfer all of their money from everywhere else onto Hargreaves Lansdown. That's kind of that's a big part of the cash thing. They want to be basically, you've got your current account, and then outside of your current account, all of your money should be with Hargreaves Lansdown. I think that's kind of the end game.
So another business that you like is Schroders. So what do you like about Schroders? Because again, we've covered quite a few of the wealth managers on the show, and we've liked them, and especially at the valuations, and they've typically got good dividends as well. I'd say for me, the one that I've liked the most of the ones we've covered is probably actually Rathbones. But yeah, so what do you like about Schroders, and how do you think about the potential disruption that is fighting off against companies like Hargreaves Lansdown?
Okay, so it's in terms of why I like it, it's the same story, consistent growth, consistent double-digit returns on capital. What do I like about Schroders? I think they're really the main thing that I like about Schroders is the name, the brand, the history, and the amount of time that it's had international operations. So let's have a look. So 50% of revenues come from the UK, so the rest of the business is outside the UK. It's been around for whatever it is, a couple of 100 years roughly, and the brand it's kind of like Burberry or Rolls-Royce or something, but in asset management. And I think that's just a useful way of attracting talent into the business. If you've got the choice of working for, I'll pick on Jupiter, because Jupiter Asset Management, because it's a company I looked at a while ago. If you've got the option of working at Jupiter and working at Schroders for the same money in roughly the same position, I'm guessing most people would want to work at Schroders, because the brand has much more weight, it has more meaning, it has more history. It's like saying, do you want to work at Ted Baker or Burberry? There's just, if you know anything about, if you're interested in fashion, and what the hell would you want to work at Ted Baker over Burberry, if all the other factors were the same? So I think it's a very useful way of being able to attract talent into the business. But more importantly is the fact that the Schroeder family still own like half the business. And so that means that you've got one massive, basically controlling shareholder who has a multi-decade, and longer, a perpetual time horizon. So that gives management an enormous amount of freedom from short-term pressures that other CEOs would typically be under. So in the way they run the business, they're not thinking, hey, let's try and double profits in 5 years, to hit some crazy target so the CEO can get a bonus or whatever. That isn't how Schroders runs. Schroders runs in a way where they're saying, well, we operate now, we make profit now, but we're continually thinking about where is the market going? Where do we need to be so that we can be successful 10, 20, 30 years from now? Where do we need to be planting the seeds so that we are positioned ahead of everyone else for 50 years from now? And so that's something that they've consistently done for a long period of time. I can remember there was one investor presentation that I watched. It was like an interim results or something, and they were talking. It might have been an investor day, and they was talking to. I don't think it was a CEO. It was another high up guy, and they were talking about some market where they were opening offices, and he said, "Yeah, we're building out offices and training people up and starting to get to know the different operators in the market." And this was in some emerging market country. I can't remember which one. And he said, but don't expect this part of the business to add anything material to the top or bottom line within our lifetimes. It will probably be somewhere after our lifetimes by the time this market becomes mature enough to add significantly to the business. I mean, how many companies can you think of where they say, hey, we are going to go and invest in country X, but it's not going to show a material profit for 50 years. I mean, that just doesn't happen. Companies, if you do that, then obviously the big institutional shareholders would immediately say, give me the money as a dividend or buy back your shares or something, because we can do something, that's shorter, that's going to produce returns in a shorter timescale. But with Schroders being able to operate like that, it means that by the time these other countries become mature and attractive to, Aberdeen or Jupiter or whatever, then Schroders has already been there for 20, 30, 40 years and has already built up lots, networks and relationships with people and brand equity and all of these other things. So I think to me, that's the main thing with Schroders. The main thing with Schroders is the family ownership and the very long-term view that it can take in terms of how the business is run. So as for the threat, I don't really see that there's much of a threat from HL, to be honest. Do you mean in terms of HL's the financial advice side, or
I guess
do you mean
it's
the
more
funds?
trying to disrupt it. I appreciate that, because my view on that, I think me and John, actually, when we've talked about it on the show, we have slightly different views. My view is, for example, say you've got say you've got like a woman that's been widowed or something. She's not going to want to go on the Hargreaves Lansdown platform and do it all herself. There's always going to be a good chunk of people that want a Schroders or someone to actually just look after them, or they just want to invest in that fund or something that they trust. But I think obviously Hargreaves is they're trying to take a bite out of everyone. So I think they are.
Yeah. So I think, I don't see that as a particular issue, because there's different parts of the market. So, you got the high net worth, and they want hands-on financial advice. And then you've got the kind of slightly above mass affluent level where they might want a kind of lighter touch financial advice, which is something that Schroders has got into with their joint venture with one of the banks. I can't remember offhand. What the hell was that called? Schroders Wealth something. Anyway, so they're kind of getting into that area. But I don't. With HL, my view on this, that from what I've heard coming out of HL, is that they already do financial advice, but it's very, very limited, and it tends to be kind of, you come to the end of your pension. Now, what do I do? You ring up HL and they will just run through your options with you. So my understanding is that they're their wealth of their financial advice. I wouldn't even call it wealth management. Their financial advice side is very, very limited. But they have kind of spoken about the potential for an AI-driven approach. So they might go after the lower end of the market where people need some sort of advice, but not hands-on hand-holding by an expert, So I think if HL expands out its financial advice side of things, it will probably be at the more mass affluent scaled an AI system, because obviously if you've got 1.6 million customers and you've got God knows how many billions of assets, and you can look at all the flows and everything, and so they've just got lots of data to work with, and obviously AI runs off of data. So if you've got huge amounts of data, they can stick that all into a giant data lake, if you want to use the jargon, and feed that into an AI system, and then they can build an AI financial advice system around that. But I don't see that. That's not what Schroders is looking into doing at all. Schroders is much higher up the kind of the wealth scale. I mean, and plus Schroders is 50% outside the UK, and the percentage of its revenues from outside the UK is likely to grow over time anyway. So even if and also that the wealth management side of Schroders isn't its core business anyway. It's I think about 20%. No, what is it? It's about so about 15% of revenues comes from wealth management. The rest comes from working with there's the retail fund side, but they do a lot of stuff working with institutions and pension funds and that kind of thing. So to me, there isn't a great deal of crossover between HL and Schroders.
Could you talk about why you like Unilever?
Yes, it's apart from it being an eye-wateringly obvious choice for a dividend growth portfolio, it's the same story as the other one. So it's got a track record of consistent growth, and returns on capital employed are typically above 15%, which is good. It's obviously a super defensive company because it sells things that don't last, that get used up, like Magnum ice cream or something that people have to buy all the time. So it's very defensive. It's got enormous scale. The brands like Dove that people know. It's been doing what it's doing now for, I guess, it's nearly a century, isn't it? So something like that. It's getting on in that direction.
Yeah.
So it's just a big scaled global defensive cash generative dividend paying company. And I mean, I guess you've got certain other attractive features, like it's got a large exposure to emerging markets. I think about 60% of revenues come from the emerging markets. Let's have a look. So 25% comes from China, India, Brazil, and Indonesia, which are even higher growth than that. And so it's quite well positioned. It's basically spent the last decade or so repositioning its portfolio so that it is exposed to higher growth areas. So emerging markets being the obvious one, but also its beauty and health business is now about 40% of revenues, and that's a higher growth area as well. So kind of my expectation is that probably the next decade or so will look a bit better than the last decade, because as these high growth areas, the emerging markets and the beauty business and whatever, as they become more and more material part of the business and they're faster growing, then it starts to drive the whole group's overall growth at a higher level. And then obviously valuation as well. I think the valuation is quite good. So yes, I'm quite happy to hold Unilever.
Yeah, I mean, we've covered it a few times on the show. It's one of John's biggest holdings personally. I think it is just a quality business, and when you look through the brands it's got, it's just so many quality brands. I think one thing that's interesting about Unilever is we've covered a few of almost like the US equivalents on the show as well. So we've covered probably the two obvious ones are probably McCormick and PepsiCo, because PepsiCo's got all the snack side of the business as well.
Yeah.
And Unilever is, I think it's at about a P of about 17 at the minute with a 4% dividend yield. And then if you look at McCormick or PepsiCo, you're paying about 30. I think it's possibly even mid-30s for McCormick. And these are businesses that are basically growing a similar amount. And it's just, yeah, Unilever's very, very cheap in comparison.
Yeah.
Well, I'd actually say that those other ones are probably priced too highly, because I think if you've got a business that's growing mid-single digits every year and you're paying a P of, say, 33, I don't see where that growth comes from. But yeah, it's certainly very reasonable compared to its international peers.
Yeah, and Unilever has also started a fairly material buyback program now, and they just sold the tea business for €4.5 billion. So I'm assuming most of that will be ploughed back into the beauty business and looking for more acquisitions and that kind of thing. But some of it might find its way out as buybacks as well. So yeah, no, I think Unilever, it's kind of, I don't think it's amazingly valued. Like it's not one of my top holdings, but it's kind of somewhere in the middle. But it's kind of just a nice,
I think it's pretty fair.
Kind of, yeah. So it's like a core holding that unless the share price goes crazy upwards or something, I would expect to hold it for a long time.
Could you talk about why you like Domino's Pizza, and do you worry about the increased competition from Deliveroo and Just Eat, as well as saturation potentially limiting growth? Because obviously they did have the international side and they've scaled that. I know the international side never made any money, but they've scaled that back and they are basically just UK and Ireland now, which does place more of a cap on the growth.
Yeah, I think, so getting rid of the international businesses was obviously a good idea because it was just distracting. And I think the main mistake they made there was going into too many countries. They should have just gone into one country and then try to make that work. Just a kind of proof of concept. Can we open another country and become the dominant market leader in that country in the same way that they are in the UK? But they didn't do that. So the issue now is that they're landlocked to the UK again, and obviously they don't have a track record of expanding internationally because they completely failed to do that. So it's an issue. But for me, that's just something that gets folded into the dividend model. So my dividend model just assumes. So they think they can have, I think it's 1,600 outlets in the UK, and they're at about 1,200. So that's something that you can just put into the model. You can just build into the model a kind of, and then you look and they'll say in their annual results what their target expansion rate is of their outlets, and so you can kind of trace that through for the next, say, decade. Let's say they hit their upper limit of 1,600 at the end of the decade, and then beyond that, you've got like-for-like growth, so inflation plus, a small amount of trying to get people to buy bigger pizzas or something. And so that's basically what my model assumes. So even on the assumption that it stays, which is quite a conservative assumption, if you just conservatively assume that it stays landlocked in the UK and then maxes out its scale in the UK within the next decade, and then only grows at maybe 3%, so a couple of percent inflation plus a small amount for premiumizing pizzas or something, the valuation is still, it's not an amazing valuation, but it's below fair value, and so I'm quite happy to hold it. And then obviously you do have the option of them retrying again. Okay, they've still got their German operations, which is a joint venture. So hopefully with the joint venture in Germany, they can continue to learn about how to operate outside of the UK. Because obviously they know how to dominate the UK, because they do. And so then hopefully the German joint venture that they've got, they can learn from that and learn, okay, well, how does the German market differ? How have we, assuming that they're successful in Germany? And then if they're successful in Germany and they learn from that and so on, then maybe they'll go and buy the master franchise for another company, for another country. So it's like an option. There is the option of them expanding internationally at some point. But even if you assume that they don't, I think the valuation is not too bad.
Do you worry about competition from Deliveroo? And
okay. Sorry. Yes. Yeah. So I think I would say I don't know is the first thing. So I don't particularly worry. So from what I've read and watched and so on so far, it's the impact is unknown. The reason being that, yes, obviously Just Eat and Deliveroo and Uber Eats and whatever are a problem, because they're going to take market share away from Domino's, because obviously now everyone just gets used to the idea of getting McDonald's delivered or and so on. However, at the same time, they are the new the upstarts coming in are massively growing the whole delivered junk food, well, I won't call it that, the hot delivered food market, whatever the proper term is. They're growing the market a lot, now compared to, especially post-pandemic. But even before that, just being able to sit at home and order food from a local restaurant and get it delivered, or now it's like Wagamama and McDonald's or whatever, you can get it delivered. So the idea, this is obviously very bad news for cinemas, the idea that you can sit in front of a 70-inch TV with an infinite number of movies that you can watch anytime you like on Netflix and so on, with a big pile of McDonald's or something, or Domino's pizza in front of you, that's becoming more of a thing. It's because obviously it's nice to sit in front of a giant TV and eat lots of pizza. And so as much as Domino's market share is likely to shrink, it's a shrinking share of a growing market. And so exactly how those two opposing effects play out is, at the minute, I think the assumption is that nobody really knows. Nobody really knows if it's gonna really materially negatively impact Domino's, or if it's even possibly a good thing. So my assumption at the minute is that the net impact is zero, and so until things become clearer, I'll just stick with that.
Could you talk about why you like AG Bar, and also why you didn't go for Britvic instead? Because I'm assuming if you looked at AG Bar, you probably did look at Britvic at some point.
No, not really. The way that I pick stocks is that I look at it's basically, it starts from my stock screen. So if AG Bar was somewhere near the top of the stock screen, then I would look at it and look at its quantitative numbers, the metrics, look at its growth rate, growth quality, profitability, debt level, and then say, okay, well, that looks okay, that looks reasonable, let's go and dig into the details. And then I would dig into the details. If Britvic, I don't really do like a peer analysis. I don't look at AG Bar and then say, oh, well, let's have a look at Pepsi or Britvic or something. That's probably an entirely reasonable thing to do, but it's not something that I do. I just look at AG Bar, and then obviously the competition coming to the analysis at some point, but I don't do like a detailed analysis of the peers. So AG Bar, the investment case just stands on its own, which is, just grab out my notes. Basically, it's the same story as something like Unilever, I guess, would probably be the closest similar company that I invest in. They make fizzy drink. Generally, people just drink fizzy drinks all the time, regardless of what the economy is doing, to an extent. And so it's got a track record of consistent growth, and the profitability is good. I think 15% return on capital employed on average. Actually, also, whenever I say return on capital employed, I mean net return on capital employed, because I use net earnings and compare that against capital employed. But anyway, so and it's the same kind of thing as Unilever. So in the obviously it's nearly purely a UK company, not quite, but nearly. It's got scale. It's got the Iron Brew brand, which somehow manages to outsell Coca-Cola in Scotland. And so it's just got it's got very powerful brands. It's been doing soft drinks for, I think, a lot more than a century, I think. So it's been doing it a long time. It's, they know how to run a fizzy drinks business. They know how, to the extent where when Pepsi wanted to do Rockstar, which is an energy drink. Apparently, in this country, AG Bar got the license to do the manufacturing and distribution, and so it's the same kind of story as Unilever. It's a defensive company, not a lot of debt, long track record. The expectation for the future is obviously it's not going to grow spectacularly quickly, but people are going to drink fizzy drinks, and the price of fizzy drinks is going to go up, inflation plus a small amount. It's one of those. It's a kind of fairly simple investment case.
What do you think of is it Rockstar that went from AG Bar to Britvic? Because that was about 7%.
Well, I can't remember where it went, but it did go. Yeah, actually, that was one of the things that I look back at, and then I tried to dig around and see, because that's what I call contract risk, where some companies have large contracts. If you only think of like rail networks, the rail franchisees there's just this huge if you've got one contract that makes up 50% of your revenues or something. I think with this it was about 9% ish of revenues or earnings that came from that license or that contract, and so that was obvious. That's an issue, that's a problem, but again, it's a kind of one-off thing, and this is the whole point of trying to invest in companies that are robust with good balance sheets, because all companies run into problems at some point. I mean, and there are other issues. There was the sugar tax thing. That was another short-term headwind. But overall, my assumption is that it's a low single-digit growth company, and you value it on that basis. And it does have a growing international business, but at the minute it's kind of sub 10% of revenues, I think. So there's going to be at least another decade before the international business becomes material.
So that's the end of the questions. Is there anything you'd like to discuss that hasn't been mentioned? And if not, where can people go to find out more about you?
No, there's nothing else I want to really cover. I think it's been I quite enjoyed our chat. In terms of where people can find me on the interwebs, I'm at ukdividendstocks.com. That's where the blog is. There's the podcast is on that site as well, although obviously you can find the podcast. The podcast is distributed through the Apple app thing. I'm not an Apple person, as you can tell, and the Google Podcasts and Spotify. And that's it. And then there's an investment newsletter on the website, and there's a YouTube channel, if you can find it, which I've just started. So that's kind of a vlogcast, I think would be the word. But yeah, it's ukdividendstocks.com. If you go there, also there's my old website was ukvalueinvestor.com. If you want to look back at and see what nearly 14 years of blog posts look like, then you can dig around on the old site. It's a good archive of articles on different companies.
Okay, well, thank you very much for coming on the show, and we'll see everyone next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.